Good afternoon and very warm welcome to the Oxford Martin School. I'm Ian Golden, the director, and it's a huge pleasure to see you here in quality, if not in quantity, of the participants, and particularly to welcome Christian Thimann to Oxford. He's come from Paris, and I want to take this opportunity of really expressing the fact that we all feel like Parisians at this incredibly difficult time. He was just telling me about some of the trials and tribulations that he and his colleagues have had in recent days, and one can't but help feeling totally in support of everything and really grateful that despite all of those things, you were able to make it over with your colleague today. Christian is now the head of strategy, sustainability and public affairs at AXA and a member of the executive committee. As many of you will know, AXA is a very established 200 years almost. I guess you're beginning to prepare your 200th birthday organization with over 90 billion euro in assets, really providing the institutional framework for people to prepare their lives for the long term by investing in pension products, life insurance, and other products, as well as offering a very wide range of shorter term products. So Christian is very much at the heart of thinking about how finance can be mobilized for the long term and how it can help us withstand systemic risk. He's a member of the external member of the French Council of Economic Advisors. He's an affiliated professor at the Paris School of Economics. He's in charge of AXA's strategic orientation, but that is relatively all a recent step in his career, because prior to that, from November 2008 till December 2013, he was at the ECB, the European Central Bank, working as Director General and Advisor to President Jean-Claude Trichet, who also is associated with the Oxford Martin School as one of our commissioners on our Commission for Future Generations. Prior to that, he worked at the IMF. He's widely published as an academic. He's one of these few people who's been able to both be highly respected academically and be central to organizations that really matter when it comes to financial stability. So we're delighted to have you here. Christian's going to speak for about 45 minutes or so, and then we'll have time for discussion. And I do want to apologize in advance that I'm going to have to slip out at the Q&A, because I have to catch a train and a plane, but I know the conversation will be excellent and Carol will host that. So Christian, we're delighted to have you here.
Ian, thank you very much for the introduction and for the welcome. I'm really honored and very pleased to be in Oxford today and to speak to you about this topic. And I must say that what I'm going to say has also been inspired by a lot of your writings, by you, Ian, by Doyne and others. So that's a great pleasure. Indeed, coming from Paris this morning, I cannot fail to mention that, of course, we are witnessing at the moment systemic risk at a much, much greater scale and a real challenge to humanity. And that, I believe, is a reminder for us to always look through our work and try to see the bigger implications all this work that is taking place has for the issues at stake. My topic today is the trade-off between uniformity and stability for global finance. I will argue that a lot has been achieved in terms of regulation after the financial crisis, and that these achievements are very significant, but that a number of open issues remain to be addressed. And the main point I would like to make is that the current design and functioning of the financial system is very much leaning towards uniformity of actors, uniformity of instruments, uniformity of positions, and that this is to the detriment of stability and detriment of effective functioning of the financial system. And I would like to go through three main points. First, to just start from the crisis in a nutshell and say what the main actions and achievements have been after the several years of regulatory action. Second, to plunge into the issue of uniformity and take you into the mines down where the technical issues lie and sort of try to unravel a few sort of the hidden issues that are really very much at the heart of this problem, and finally sort of reflect a little bit on the way for action. What can be done? Why has this issue gone unnoticed so far? And so how can one bring the subject forward? So that's the agenda for the next half hour, 45 minutes, and I'd like to go through that with you. And then I'm very much looking forward to your questions, because it is really, I believe, an issue that needs much more challenging and much more attention. And I think that's something where the Oxford Martin School is already providing a lot of insights into. If we just put ourselves back to the crisis, we have seen the many years of building up the bubble. Then it is well known that the crisis meant that a large chunk of financial values that were sitting on the bank's balance sheets were destroyed. And in order to prevent this from weakening activities of somebody else had to step in, and the government stepped in with the TARP programs, the bank recapitalization programs, so put things back on the bank's balance sheet to be able to stabilize the system. And the magnitudes, of course, are absolutely staggering. The banks had lost trillions of assets on their balance sheet. The stock markets had lost amounts roughly equivalent to 40% of GDP in the aftermath of the crisis. So there was a gigantic hole on the balance sheet, which could have translated into very adverse effects onto the economy. The government stepped in to replace demand, but of course governments, if you think about it, they can't really create demand. They can just bring demand forward in a way by imposing higher taxes on future taxpayers. So in that capacity is of course limited through debt ceilings, to financing problems, and this is why the government support at some time came under a lot of strain. And maybe related to that, thereafter the central banks stepped up their action, and the central banks have the advantage that they can really create money without limits, theoretically at least, and they stepped in and they bought some of these assets that try to sustain market values in order to give time until the whole adjustment of the system is being done. But as you see, of course, this is an issue that has not gone away. We still see the aftermath of the crisis now on different people's or bodies' balance sheets, and you also see the effect on the real economy that is far from achieved. And who has borne the brunt? I would say, well, of course, the financial development prior to the crisis was very much about inequality, right? We have seen the adverse development of inequality in the run-up to the crisis and the adverse impacts immediately after the crisis. The government support is very much based, of course, on the taxpayers group. And now the question is, what is the central support? What are the issues there? And these are also very important issues there. First, it affects literally every citizen. And second, the issue is, of course, that also monetary policy cannot create demand. Monetary policy works by moving aggregate demand over time to bring it in line with aggregate supply to manage inflation. And that means, of course, they can bring aggregate demand forward in time. But this is, of course, an issue for the long-term saving. And this is what we see nowadays. So consumers already raise their level of indebtedness in a way and bring their demand forward. And we will, I believe that's a very safe prediction, in a number of years face a very severe issue on the long-term savings issue. So the provision of long-term income will become something absolutely important, and that is an issue that will occupy us certainly in many years to come. So if we look at the actions of the regulatory measures, there have been, very, very many at the global level. We have seen the confirmation of the Financial Stability Board as the prime global regulator that has launched a whole program of initiatives. We have seen in the United States the Dodd-Frank Act that has 16 major regulatory initiatives, has created new institutions, has looked after banking regulation, insurance regulation, at least for the systemic one, has worked on systemic risk, has created the FSOC, has created other institutions, has given more power. And if you want to illustrate this, the chart I found was this one, which sort of illustrates the rules applicable to the US financial holding companies since July 2010. I'm very sorry that it's difficult to read, but this is just because there's so much of it that the font is small. but those for us that have eagle eyes can identify many of the issues. You see the leverage ratio, the Volcker rule is there. So you see the gigantic framework of rules and regulations. So I believe we have to say that the regulators did a very serious job. They worked very, very hard. They did a very comprehensive job. They did not shy away of looking at institutions and at the system, at least in some way. They also looked at the consumers of financial services. And you see they did a whole 360 take on these different bodies. You will also see that it's slightly incomplete. It's only the federal level, so there's also action at the state level. So this is only part of the story, but it shows sort of very much the outreach in terms of complexity of the rules and intensity of the rules and intrusiveness. So there's a very, very hard job, and you've all heard about the length of these documents and the intrusiveness into the financial system, which certainly was very warranted and very needed. In Europe, we don't have one big egg, we have many smaller eggs. The European Union was very active as well, and the European Commission launched 30 major regulatory initiatives, which you all see on this chart, in the years following the financial crisis. You will see it starts in 2008 with the credit rating agencies, you have the Capital Requirements Directive, you have the creation of the European authorities on banking, on securities, on the markets, on insurance. You have the market regulation, you have the short selling directive, and if you see somewhere the abbreviation MAD, it is not the state of mind, it is the market abuse directive. So literally everything has been thought about, and you see here too, these are all major texts. I mean, I just take the CRD4, which is of course the implementation of the Basel III framework, that by itself is a major text. We have the same on insurance, Solvency II is there. You have the Banking Recovery and Resolution Directive. So also in Europe, there's been a very, very thorough exercise to work through the consequence of the financial crisis and to go systematically through them. And I would say the achievements are absolutely significant and we must not overlook them. And I would say the achievements are threefold. One, the institutions are individually stronger. We would say that indeed it is confirmed that banking institutions, all financial institutions by and large, are much more stable. They are much more capitalized, they have more liquidity coverage, they have better risk management, there's more investigation of compliance, they've looked after their compensation rules and so on. So indeed, this is the first major achievement. The second major achievement is strengthened supervision. A lot of investment into supervision. I mean, the ECB is taking over banking supervision, looking at the systemic banks directly. In the Federal Reserve, the same. The Bank of England, very much the same. We are seeing new regulators being created, new institutions being created. Supervisors have stepped up their resources. They're much more intrusive, so the quality of supervision has been strengthened very, very significantly, and also the intensity has. And this is the second very important achievement. And the third achievement, I would say, is the better functioning of financial market transparency, in the sense that at least the most complex financial products, you remember the CDO squared, CDS squared, and the ABS squared, and so on, the very complex financial tools are partly prohibited. On derivatives, there's move towards central counterparty clearing rather than do it bilaterally. So I would say that there is a stepping up of issues very much towards better financial market transparency. So these are three very important achievements that have been done and that have been absolutely necessary, and these are really something one can say with confidence today that there's a significant improvement in the financial system. But at the same time, there are a number of open issues, and I would like to highlight 5 of them. And the 5 issues are, first, there's still a sense of fragility. There's still a sense of that there are unchecked pockets of risk. If you just take the notion of shadow banking, this notion of migration of risk, so there's something, a notion that still a lack of fragility. The second issue is, perhaps ironically, a lack of control. And this may be due to the higher complexity of these systems and of these rules. I don't know if these reports are confirmed, but there are reports that a bank like JP Morgan is employing over 950 people to look after the new regulations, 300 people for the implementation of the Volcker rule, 400 for the others, and so on. So there's a stepping up on financial institutions, of course, to sort of be abreast with the rules, ensure implementation, ensure compliance. On the side of the regulators, of course, we have the same. So both sides are stepping up their troops, if you wish, and there's much more intensity and a much bigger complexity. And whoever one talks to on either side is really struck by the complexity of the issues, both on the side of the industry and on the side of the regulation. So that is a second issue that remains on everybody's minds. The third is what we could call inefficient liquidity. Yes, liquidity is abundant, it's abundantly provided by the central banks, but still it doesn't seem to be reaching the real economy. It doesn't seem to be reaching what we normally would think would be great. I mean, interest rates are low, it's the investment paradise in theory, but in practice there's no investment boom. Right? Investment is not taken up on the long-term risk, it's not uptake to innovation, we don't see it very strong as job creation, so that is the third issue that remains open. The fourth issue is concerning emerging market economies. One would think that with low interest rates in the industrial world, that they would be benefiting from huge capital inflows, but yet they don't. So in a way they are cornered today. They don't seem to benefit as much as in the past from such capital flows, and that is also an issue that remains because after all, we are counting on their catching up and their greater importance in the world economy. And the final point is sort of time inconsistency between a focus on liquid, short-term, and very homogeneous assets, on the one hand, in the financial system, and the needs of the economy that is looking at a very broad spectrum of issues on job creation, on long-term investment, and so on. So there's a tension on the dilemma of the horizons, and that is, I would say, the fifth issue that is very much felt in global financial markets. And I would say that the issue that we are facing with the issue of uniformity is importantly related to that. Let's look at uniformity now. So I'm in the second part, and let's go through just a few issues, and I'd like to focus on the latter ones. But just to recall the uniformity of actors. I mean, this is the global, in banking and investment banking world. You see products, regions, industries, and what counts are simply the colors, because you see the sector leaders each time, and you will realize that there are in a way 4 investment banks that are very much dominating the whole investment banking universe. So both on global investment, M&As, bonds, equity loans, the regions, Americas, Europe, Japan, China, United Kingdom, Hong Kong, and also the industries, the financials, healthcare, high tech, and so on. So the first point I'd just like to recall is that on global financial markets, there is a relatively limited set of actors that matters, and that are the dominant players in each and every segment. So that is perhaps particularly important when coupled with the fact that also the media, I mean, there are 2 global media reporting on financial markets. There are very few thought leaders. These are the main banks that come out with analysis. So I would say there's quite a restricted set of people that are operating, at least in leading global financial markets. The second point I'd like to make is sort of interestingly, I find that the holdings of government bonds has increased. So the rising uniformity of instruments. So here you see that over the last 10, 15 years, the holding of corporate and government bonds has increased very, very much. And this is here the holdings of life insurers. And we will come to that in a moment. It is quite paradoxical for people who don't know the insides of regulation and accounting that life insurers would have only a fraction of their assets in equities. Because we know that over the long term, it's equities that perform very well. We know that these are assets that have a lot of short-term volatility, but over time produce a very significant return. And if you go to anybody for long-term saving, any advisor would tell you to put a fraction, a significant part into equities. So why is that not the case for life insurance companies? Why do we see the rising focus on a relatively limited asset class with government bonds and corporate bonds? Why is that so? And why do we see other investment, real estate, mortgage and so on, relatively at the margin? That is the other, I would say, important issue regarding uniformity. So about much uniformity on a limited number of instruments. And I would say it's not innocent for savers. And I like to illustrate this with the following, that in a way, where does that come from? I would say it comes from the fact that we have we have capital charges, you see that illustrated on the left, being lower for government bonds, higher for corporate bonds, even higher for equities, and so on and so forth. Capital charges means that's the money an investor has put aside of own funds. So for example, if you're an insurance company under Solvency II, you have to hold 0 capital if you invest in government bonds. If you invest in equities, you have to hold 39% capital. That's the standard formula under Solvency II. So you see the capital charges is rising between asset classes. Please.
I just wonder if things have really changed. In the past, there was the 40-60 rule that you had 60% bonds and 40% equities.
Yes.
Do you see that shifting? Because in your previous chart, the percentage in bonds was the percentage in bonds higher than that?
Yeah, we have seen exactly, you said the 60-40. Today there's no more the 60-40 rule. Today we are more the 80-20 rule or the 80-10-10 rule. So most big life insurers under Solvency II would have 80% in bonds and a fraction of 10, if not only 5% in equities. And the question is, why is that so? And I would say capital charges is part of the answer in the financial system, because capital charges are ranked between asset classes. And also eligibility with central bank refinancing is ranked. The easiest to refinance is government bonds and corporate bonds. For equity is generally not possible, and loans is also quite difficult. So if you like, you can, and this is what I try to illustrate with this chart, think of the global financial systems of concentric circles. You have government bonds in the middle. They have the lowest capital charge, completely eligible. They are also the preferred asset class in regulation, if you think, for example, of Basel III. Basel III is the capital charge framework for bank, but also has introduced the liquidity coverage ratio, and this is actually one of the most stringent new features of Basel. It has put the obligation for banks to hold high-quality liquid assets against 1 month potential outflow of liquidity. So banks have to estimate what could be the outflow of liquidity over 1 month, and they have to hold this in highly liquid and high-quality assets. And the definition of these assets is that these are bonds that are quickly can be realized and sold in financial markets without a loss of value, and the regulation is centered around government bonds. So these are, if you like, the preferred assets. So then you have corporate bonds traded as a markup of that, you have equities traded as a markup on equities, and you have alternative investment infrastructures. So I believe you can think of the financial system being organized in that way, sort of as concentric circles, and being also fostered by regulation of our thinking government bonds are safe, and then it gets less and less safe. The only problem is the red arrow on the chart, that the job creation, the job potential, the link to economic growth is actually inverse to that. Right? It's not the government that is creating jobs on a net basis, it is the private sector. And in the private sector, it's often not the large firms, it's the small firms. It's not only on current business, it's on new business. And for all of this, we know in Europe and the UK and in France and Germany, we especially have a very big need of infrastructure investment. So you see we have a tension between the social and economic desire to move outside these circles and the pressure from the regulation to be as close to the middle as possible. So that is, I would say, one of the tensions that we see today in the markets between the broader economic needs and the attempt to stabilize the system. And if you look like another parallel, you could say, well, stabilization brings you to the middle, growth moves you to the outside. So today we are very much moved in the middle, we are safe there, we feel safe at least, but we know growth, innovation, job creation is on the outside. And this is, as I said, not innocent for savers. If you look at the implications on interest rates, you see here over the last 15 years the movements in the bond yields. That's the euro area bond yield, the dashed blue line, and you see that has recently, of course, declined very significantly, also because of QE and other actions, and the demand for government bond that is very high. And you see the inflation rate is somewhat below. But if you think about the long-term saving, and we're interested in the long term, what are the two main savings motives for people? Well, the two main savings motives are housing and long-term income, old age income. Housing, of course, is the prime motive, either for yourself or for your next generation, for your children. And the second motive is health expenditures. So this is long-term care, and you know that 50% of your health expenditures are paid in the last 6 months of your life. That's when you really need savings if you want to have good long-term care. So this is the second motive why people save. And now the interesting thing is if you look at the components of inflation, you will see that these are actually components that have higher inflation rates than the overall CPI. On average in Europe, the housing is around 4%, if not higher, because there's a big increase in house prices, and health expenditures are also very significantly higher than the CPI. But then we have the issue, how can people save for this with safe assets? You see, with safe assets, you achieve a return of 0.5 or 1%, but the issue you want to save for is growing in prices at 4 or 5% per year. So how can young people put money aside for the future for a house if, you know, the return on what they believe is normally the safe asset is lower than the price component they're saving for? And the fact that the overall inflation rate is lower, well, this is food prices, this is electronic goods, and so on, but that's not what is the main savings motives. So here you see the tension we have from this development on the long-term saving structure. So this is what I said, that will be one of the big societal issues to look at the implications for long-term saving. If we now turn to another aspect, which I like to dwell into a little bit more detail, and this is the impact for the insurers and bankers compared, because banking and insurance is a very interesting comparison because they have a few similarities but many differences. Banks and insurers are both, in a way, financial intermediaries, and banks and insurers are both investors in financial markets. But their liability side is very different. And you see here is a very stylized illustration of an insurance balance sheet. So you have on the liability side, you have motor and the short tail of property and casualty insurance, very short maturity, 1 year horizon typically. Then you have other property and casualty insurance, which can be longer term. You have protection and health insurance, which is even longer term. You have savings, which is then even longer term, and we are already in the mid-years, 7 years on average maybe. Life insurance, longer term, and then you have some very, very long-term liabilities. It would not be untypical for insurance companies to have some liabilities which are 20 or 30 years maturity. Typically, you know, if a young person with 25 or 30 years buys life insurance, well, the payout would be expected 30 years later. So you have a very structure of staggered maturity structure on the liability side. And you have the same, in a way, on the asset side. So this is why you can think of the insurance balance sheet like a pyramid. And that's very different from banks, because they also have a staggered asset side, but of course the liabilities are much more shorter term overall, because the main liabilities of banks are deposits, and the bulk of deposits can be withdrawn overnight. So the asset side may look somewhat similar, but the liability side is very different between insurance and banking. So this is why the structure of the balance sheet and the key item for insurers is really asset liability management. That is the key function of the technicians inside that try to match assets and liabilities. And therefore you see there's a small part in cash, then you have lots of bonds, you have a little bit of government bonds and so on, down to real estate. And the question is, however, what are the issues we are facing as our insurance companies are facing with regard to the liability structure and the asset structure? And the first point I'd like to look on is the regulation that looks at systemic risk. And you see here, this is the Financial Stability Board's systemic risk framework for banks on the left-hand side, for insurance on the right-hand side. And despite the difference in balance sheet structure, you see that the rollout of the framework of of systemic regulation is very similar. So 2011, the FSB rolled out the framework for banks, identified at the time 28, now 30 banks as systemically important. 2 years later for insurance, 9 insurance companies systemically important. And you see the justification, the implication are very, very similar. So there's the idea to look at these institutions very much from the same angle, to sort of have a treatment that is quite uniform. So we try to identify the biggest players. We impose sort of very similar implications on them, systemic risk management plan up to capital surcharges. And this, in a way, creates also uniformity in action. So although the business model is very, very different, the systemic regulatory framework that is proposed by the FSB and currently in the phase of implementation is very, very similar. But that's only one aspect. If you look at an investment action, what is very important is actually the regulation itself. And here, this is where I'd like to take you down really into the minds of the regulatory framework and discuss one aspect which you may have heard about in the solvency framework. It's called the long-term guarantee system and the volatility adjuster. So the regulations were completely aware that exposing insurance companies to volatility is not the right thing because their liabilities are long-term. And so they have designed a volatility adjuster that takes out some of the volatility in the markets for the insurance companies. But the question is how they do that. And that's very interesting. And I'd like to read to you the article concerned that says, the volatility adjustment, and I put my own emphasis, shall be based on the spread between the interest rate from a single standard uniform reference portfolio and the relevant risk-free interest rate. And the reference portfolio, so the notion of a reference portfolio shall be representative for the assets. So what actually the regulators do is they look at the last year and they look at the average portfolio of insurers in that given market for the given currency. And then they give you the volatility adjustment based on the reference portfolio. But you see, the point is that even though insurance companies, and there are hundreds and thousands of them, are very different in size, in business model, in asset structure, in liability structure, and we want diversity, and they're all diverse, the volatility adjustment is done on a single average reference portfolio. And you see the weights down there, you see the weights for government bonds are very significant. Belgium 50%, France close to 40%, and so on. So what we need to know is when we ask ourselves, how come that many investors act in a uniform fashion? How come that insurance companies in the regulatory framework are not as counter-cyclical as we would like them to be? How come that they invest in a similar fashion? Well, one of the reasons is that a very important element of their regulation, and that's just one example, has a uniformity of treatment idea. So trying to measure the average of the market and trying to benchmark whatever your portfolio have against the average. And the result is, of course, it's good to be in the average. So most companies are pretty close to the average because you must have very strong reasons to be at a different point. So if you ask, how come, I would say, well, we have the capital charges framework that are very significant in steering investment. And again, 0% on government bonds, 39% on listed equities is a very significant difference, has a huge impact on investment decisions. That's one. And the second, even if you look at the internal mechanics of the system, you will find several points, and that's just one very important of them, where you see that the treatment is very uniform across different actors. And this uniformity means, of course, yes, everybody is very similar, everybody's behind the same assets, and you compare that with the others, people are very much in the circle, in the middle of the circle of the system, and very, very little around it. That's one big aspect. I'd like to come to the other big aspect, and that's the accounting rules. And as you probably know, accounting is often seen as a very technical area and is mostly where one loses the majority of listeners or the majority of readers. So that is really the big challenge, but actually it's a very political issue. And no wonder that the positions on both sides of the Atlantic are very, very different. In Europe, we go much further into the marking to market, for example, insurance, than we go in the United States. And I'd like to explain to you what this means in practice. So you know that the case of fair value, the IFRS defines fair value as the price that would be received to sell an asset in an orderly transaction between market participants at a measurement date. And it stresses that that definition emphasizes that fair value is a market-based measurement, not an entity-specific measurement. An entity's intention to hold the asset or settle it otherwise is not relevant in measuring fair value. So what does that mean in practice? It means fair value is an exit price. It's the price of the asset if you want to exit today. So it's the price to sell an asset. It's therefore generalized for everybody. It's not specific to an entity. So even if you want to hold the asset up to maturity, if you want to hold the asset for years or decades, you still have to apply to it at the time where you have to publish your balance sheet, the daily price. So let's look at the chart. What do we see in the chart? We see the S&P 500 over 1 year. You know that insurance companies are measured over 1 year. And you see here the volatility, and I think it was not a very dramatic year. It was actually quite a regular year. So you have to publish the balance sheet at the end of each quarter. Now, when you publish it at the end of March and end of June, that's one thing. But if you happen to publish it at the end of September, you see you have to take the full markdown. And you can say, well, but that's not the asset I want to sell in September. And by the way, I don't even want to sell it in October or November. I'd like to hold it for years. It doesn't matter. You have to apply that daily price by publishing your balance sheet at that time. That is what mark-to-market means. And this is, of course, very relevant for short-term actors. If you're a trader, you need to know the price on the 30th of September, on the 1st of October. That's very relevant because you're acting on it any moment. So the exit price is very relevant at any point in time. But for insurers, it's very different because many insurance companies don't hold the asset to exit it. They're buy and hold investors, and they want to use the exit. So that typically means for equities, they want to get the dividend. They want to use the dividend over time. So they look at an equity investment and look at the dividend yield and say, oh, does that dividend yield comply with my payout structure as I expected over the next couple of years? So you have, on the one hand, the exit value, and on the other hand, the use value. And the paradox is, if you look again at banks and insurers, that you know that banks need to mark only the trading book, not the larger banking book. Well, I let you guess what applies to insurers that don't have banking and trading book, but in a way that generally hold assets to maturities. Well, the paradoxical answer is they have to market the entire balance sheet, except footnote for real estate, but as you've seen, that's a small fraction. So paradoxically, we are in a situation where we ask insurance companies that are the long-term investors to mark a much higher fraction of their balance sheet on a day-to-day basis. So that is really the issue we are sitting in, despite the fact that these are buy and hold investors. The whole thing gets aggravated because there are impairment rules. At the current system, there are impairment rules, so if the asset drops below 30 or 40%, it's impaired, so you have to treat it very differently. You cannot repair it when the asset price jumps up again. So if you ask practitioners in the business, why are you so cautious about equities? Well, the answer is because of the capital charges, because of the marking to market, and because of the accounting rules on the implications for the short-term P&L. So these are all three very, very important reasons that are very, very significant. And this issue, of course, goes back to the historical debate between the use value and the exchange value. And it goes back to Adam Smith, who highlighted the paradox of value, and I quote, he says, "What are the rules with which men naturally observe in exchanging them either for money or another?" He says, "These rules are what we determine the relative value of goods." And he says, "The world has two different meanings. One, the utility of some particular object, and two, the power of purchasing other goods. The former as value in use, and the others value in exchange. And then, you know, the famous example, he says, the paradox is that the things that are really useful have low value, water, and the things that have really high value, diamonds, are actually pretty useless. So this is Adam Smith. And I mean, this is a long tradition, to quote economists. Many, Adam Smith, Ricardo, and others have looked very much at the objective, try to have the objective value, and the neoclassic economists very much looked at the exchange value. The paradox is that if you think about an extreme, the exchange value of all assets is zero. Because if you think that you really, really like to change and sell your bank or sell your financial institution at a moment, you exchange, you put all your assets on the market, and everybody does that, the value is, strictly speaking, zero. So that is the paradox that we are facing. And I would say that therefore, there's really an issue in this marking to market which has many intellectual appeals, but sort of the tension between the long-term orientation is a very real one. And I would say that it is also one of the biggest forces of uniformity in financial markets. We all may have in this room probably a very different view about the future of electric cars. So companies that build them would from us all receive a very different price. And some of us would hold the assets for long, others would like to trade it, but the fact that we all have to apply the single market that's done on the London Stock Exchange at that time and publish our balance sheet with it is sort of whatever we have in all diversity, condensing it into one single value. So I would say that marking to market is perhaps the biggest force creating uniformity in the system. And the problem is also that this means that the exchange value fluctuates for reasons outside the asset itself. So the exchange of electronic cars are influenced by the global price of carbon, the global price of oil, which has nothing to do with the use value. And this is yet another very, very important point. So all values and future value is brought into the present time. So in order to illustrate that, think of a windmill that you would like to invest in because it's a long-term investment, it's an infrastructure, it's very good for the climate as well. And so what you actually buy is, you can see it in two different perspectives. You can say you buy the use value or the exchange value. And I think it's useful to go through these two. The use value is really what long-term investors do. So they would buy an equity mill, hold it for 20 years as a buy and hold strategy. And the cash flows are very predictable over the whole period. The return is known. And what you actually buy, you buy a flow of wind. If you invest in a windmill, the electricity price is regulated. Normally, you can predict it. It's fixed in the contract. So if you like, you can have already the whole returns over the period, over the next couple of years, 10 or 20 years, fixed. So you have the stable use value is over any period of time, a given amount of wind that is translated to energy, that's translated to revenue, cash flow. So that's, if you like, your asset. Time is real, the future remains the future. If you look on the other hand of a short-term investor, the short-term investor would say, well, this is an asset I like to buy and sell, and my exposure to wind electricity depends on my exposure to oil, on others, depends on developments in the oil price and so on. So this investor would permanently assess buying or selling. He or she would constantly worry about latent capital gains or losses. The prices would be marked to market, and time is discounted. So the whole future is brought up to the present, and then the discount rate matters a great deal, so you have a lot of fluctuations. And also you see there, this little chart is the European forward electricity prices in different countries, and you see the enormous fluctuations, it's minus 15-20% over a period of a couple of years. So you see that if you are a buy and hold investor, normally you're in a world of great stability. If you're not, you are in a world of great instability and greater fluctuations. And the question is, how do you assess the balance sheet? And the question is, should one apply a single method to both investors, or should one apply two different methods, and what are the implications for that? So this is what I would say about the issue of uniformity, and maybe just in closing, ask, why does nobody see it? And I'd like to show you a painting from a famous painter with the name of Mondrian. And that's an original painting, and normally, I don't know why, people don't show the letters in that, so I put them back in. So that you see here the true and full picture, how I would say Mondrian would have seen the regulatory landscape. So you see here all the very relevant, very important institutions. They're all very well placed. They know where they are. They have their fixed mandate. They know which job they have to do. And I would say they do this very well. The only question is, who's seeing the bigger picture? So who do you want to talk to if you say, I take the Oxford Martin work now to the practice, Ian, who do you go to first? Probably you go to the G20, that's certainly a good choice, but you could have gone to the FSB, maybe to the BCBS, the Basel Committee for Banking Supervision. One can go to the Commission, the European Parliament, but could also go to any Ministry of Finance, the Federal Insurance Office, the FSOC in the US. You could go to EIOPA. ESMA would be a good address to go to as well. Certainly Bank of England would be high on your list, but don't forget about the Fed and the ECB, please. The ESRB is, of course, a very important body in Europe, but so is IOSCO, and so is the IIS, which is the International Association of Insurance Supervisors. So everybody has their mandate, everybody sees their picture, but the question is, who sees the bigger picture? So how do you put that in action? Who do you call? The Kissinger question. Who do you call if you want to give traction to the Oxford Martin work, I would say, or if you want to give traction to questions of long-term orientation, overcoming uniformity? So that is the question I'd like to leave you with. And only one last chart. I've been reflecting about how the future might look like, because it seems to me at the moment we are everybody's very much focused on institutions. The systemic framework is looking at institutions, the biggest one, and a little bit looking only at them and not so much looking at the detailed activities. So if you want to illustrate that, you would say, well, on the left-hand side, we have here 4 banks in red and 4 insurance companies in green, and you see the bubbles illustrate their different activities. They all differ, but yeah, these are the banks. We regulate them as banks, and we regulate them as insurers. Maybe the future will look very different. Maybe the future where you have disruptors coming in, and they take out activities by activities, maybe we will go to a world where activities are much more important. If you looked at disruptors in the system, Lending Club in the US is not a bank, but does peer-to-peer lending. Uber is not a transport companies, but transports millions of people. Airbnb owns no hotels, but arranges nights. Wealthfront, an asset manager and a robo-advisor, does that too in a very specific slice. So maybe we will move to a world in the future where we look much more at activities and regulate activities rather than regulating institutions. And maybe then the issue of uniformity would be slightly easier to address or not, but I believe in a way it remains a very important issue. So in conclusion, I'd just like to say that I believe that really the issue of uniformity of treatment is something that is completely understandable post-crisis, but that would need to be addressed if we really want to go in phase 2 and look out how we address the broader economic, social and environmental challenges of our time. It seems to me that there is a tension between stability and growth at the 2 ends of the spectrum, and also a tension between the debates in public circles about short-term stabilization and the debates in practitioner terms, which is innovation, economy, social issues, climate issues, and how we address with them. And I believe that if we tackle this issue of uniformity, it would be one of the stones in order to go a step ahead and achieve better alignment of the financial industry and financial markets with the needs of the real economy and the needs of society and the needs also of the environment. Thank you very much for your attention.
Thank you very much, Christian, for that really tremendously, I think, insightful presentation. You know, for people that care about this issue, as I do, this is incredibly source of optimism, because you clearly really do understand. Who will I call? I'll call you, will be the answer in my head, because you're the first person I've met who's really been able to put this picture together in this way. So I think this is really incredibly insightful and something that we will share much more widely. By the way, this is being webcast and videoed, so it will have a life beyond this room, and might be having that right now from people going from far. So we have about 40 minutes for Q&A. Might not need all that time. And Carol over here, who's head of outreach for the school, will manage that process. But thank you very much.
Pleasure. Thank you for the invitation.
Okay, who wants to go first? Anders.
Thank you for an excellent talk. So I have been looking a bit at the use of risk models in insurance, and that seems to be another contributing factor to the uniformity. At least for catastrophe risk models, people use the same vendors, so they become correlated because of the models they use. And then regulators get very happy when they find models they recognize rather than the weird in-house models. Do you think the change in regulation you mentioned at the end might also help against this model uniformity?
Well, first would like just to confirm that what you're pointing to is a huge issue. I mean, the climate risk is an issue that we see the intensity and frequency of events rising every time. The insurance company I work for has paid out last year €1 billion in claims related to climate events. You've heard in the south of France a couple of weeks ago, there were the flash floods. There was 2 hours of heavy, very heavy rain around Cannes. With people who actually died, and the just material damage for the insurance industry was €500 million. So in 2 hours. So indeed, there's a big race. It's a very, very big issue. If you are in the shoes of the insurance company, I think I would say long-term longevity is a big risk, and climate is the big other risk. So what we do see is that insurance companies invest more and more in models. I would say the larger companies are developing more and more internal models. So the company I work for is investing in our own model because that allows you to be much more granular with regard to the risk exposure you take and indeed to differentiate yourself and to really look much more closely there where you have your own exposures. I think if we sort of look ahead and fast forward many, many years ahead, what would be very interesting is also to give social use to the data we all have on climate risk. And this can be data that cities would have, that can be data that individuals have, that is data that insurance companies have, and that would be very useful to predict risk, climate risk, and also to prepare resilience plans. So to answer your question, I would say we see more and more investment. It's a rising issue for insurance companies. I see especially specialized insurers, reinsurers, and the large insurance companies more and more investing in their own models.
We'll go here first.
I guess my question is related, and it might be on the margins of your talk, so if that's the case, I apologize. But your 5th point, timing consistency. For me, I'm particularly concerned about the speed of money, and that has also got something to do with stability in the markets. And with regard to sustainability, if you're able to have a premium for people who invest for the long term and maybe prejudice short-term transactions, then investors would deeply want to know the environmental and social impacts of their investments, because otherwise it would be significant risk. Otherwise, if there was an environmental catastrophe, somebody could take their money out very quickly. And that since maybe 95% of shares are traded by machines, instantly, that's also significant risk because it puts in huge swings because things, fire off sequential actions and big risks. So is there a way that maybe we can stop quarterly reporting, that have a system which allows for longer term decision making and investment, which actually will bring a lot of stability to the whole market?
Well, thanks for your question, which is a very important one. I believe there is, however, also the legitimate desire for investors to have information. And there is also the argument that, well, all information is captured in the market because every information should be impacting the price. What you're pointing out to is that indeed people who hold an asset for different time horizons have more or less efforts to invest in them, right? If you just are interested in the short-term development over time, you may look less into the governance structure of the company and so on. And I think that's a very legitimate point. My sense is that we are all collectively just realizing this about now. So we are in a phase, also after the crisis, the appetite to stabilize the system, right? To put capital and liquidity as much as in it as possible, and also to focus very much on the single market price. I believe that indeed what you are saying is something that people are getting more and more aware about, that namely the investment horizon also makes a difference to that. If I try to come up with an example, I would say there is currently a reflection, very topical because, you know, of the climate conference coming up in a couple of days in Paris, about climate and assets linked to climate exposure. And so there's a debate in the industry. So far there's no guidance or no demands from regulators, but how to treat assets which have a negative externality on the climate. And you see that some companies have decided to disinvest from coal, for example. AXA is among them, because we have realized the negative externality, and we believe that if we are credible as a long-term investor, we indeed need to take these long-term implications into account, which may not yet be completely reflected in the current market price. So it is an investment decision. We think it makes sense from an investment point of view, but we think it makes predominantly sense because we want to be credible as a long-term investor. We want to make clear that we care about the long-term implication, therefore look at also other aspects than just the purely short-term financial return. And this is something I believe we need much more public debate upon that. That's why I think what you do at the Oxford Martin School is so important. I mean, the diversity you bring here as researchers into the debate, the different perspective, I think are extremely necessary to open up the debate. And I think we're just at the beginning of it.
At the back, and then I'll come over here.
Yes, thank you for your talk. I would have two questions regarding the figures and developments you showed us with the concentric circles. So the first one would be, you mentioned that the fact that more and more regulated entities move further to the center of that figure, to the most liquid circle, so to speak, makes the system somewhat safer. But doesn't the fact that all the guys in there hold the same securities make the system actually less safe? That's the first point. The second one is, if I think about the outer circles, and you said that the regulated entities don't really go there anymore, who holds that risk nowadays? Is this the topic of shadow banks, so to speak, that you didn't really touch upon?
Yeah. Very good question. On the first question, does it make it safe or does it make it seemingly safe? I would say it's good to have in mind the difference between individual rationality and collective rationality. That individually it's very rational to go for short-term safety. That's where the regulators ask you to go. So you just go there, you obey. So indeed it makes it seemingly safer. I think that's why it has been designed. They have looked in the past and they have said, government bonds would default, we didn't see that. They maybe closed an eye on Greece, so to say. Whereas equities, we have seen the internet bubble, very significant fluctuations in the past. So I think that's totally right. If you look back, if you look forward, you ask yourself, if I want to offer somebody a long-term saving instrument, do I really want to offer him, a government bond of a highly indebted country wherever in the world it's located, or do I want to offer him or her a long-term equity proposition that's linked to the real economy, innovation, and so on? So I think it's like, in theater, they say if you're in a theater, individually, it would be rational to stand up because you see much better, but collectively, everybody would stand up, and then you see as badly as you saw before, and all have to stand. So it's a little bit that, I would say, yes, it is. I think you have put the finger on the right point. It looks more stable, but if we really ask ourselves, we see day to day that we are missing an important issue. We are missing the investment, we are missing innovation, we are missing job creation, and that over the long term cannot make the system much safer. Your second question was on the shadow bank. So who bears the risk? First, I would say there is not so much risk out there. I mean, we have the Juncker plan is supposed to come along, but we don't see that there are many interesting investment projects, infrastructure projects, for example, to invest in. We see that there's a big supply problem. If we ask me today, what's the problem in infrastructure, we say a lack of supply. We don't see, let's say in Europe, supply of economically viable, relevant infrastructure projects which would promise sort of a reasonable cash flow and provide you regulatory stability. So I would say there's a shortage. There's also a shortage on venture capital, on innovation financing and so forth. So this is, I believe, one of the reasons why people go much more to the US for these financing instruments, because this is much more abundantly available. So my answer to your question would be, who bears it? I would say, well, first, there's not a lot there, and who bears it? Sort of alternative funds and alternative instruments.
Thank you. I'm a researcher and mediator in the UK banking system, and I was wondering if you had some more specific ideas about the role of uniformity in the UK, because, you know, here we have a more concentrated and homogenous banking sector, which is quite unusual in Europe. We have a really powerful institution, the Bank of England, running regulation, and also, in addition, we have a government which is quite explicit about wanting the finance sector to be an engine of growth and job creation in this country. So I'd love your views on the UK in particular. And then on your last question about how are we going to move forward, I just wanted to give a little plug to a project I've been working on for the last 2 years called Banking Futures, which is a public consultation and dialogue with politicians, regulators, customers, civil society, investors, to try and have a broad understanding of all our needs and all the things that we could be doing to change the system, and to create a holistic idea about how we can move forward in a way that can really create a banking system that serves the economy and society at large.
Well, your first question, I don't have many insights on the UK in particular. I can only tell you that it's probably the same in many other countries. If you take Switzerland too, they're also, very dominant bank players whose assets exceed the size of the country multiple times, a very strong regulator, and that's true in other countries. In France too, the market is dominated by less than a handful of large banks. So that's the nature of the issue, I would say. But the low number of institutions is only, I would say, one aspect within the country. What I was showing more that if you take a global perspective, you see the same names in important markets popping up again. But more importantly, I find, is to look at the functioning of the system. So it's the different treatment of different asset classes and the tension between, if you like, their alleged financial stabilization quality and their economic, social, environmental quality. And that's, I think, where the main tension is. And I think I'm very encouraged by your project. I believe one of the interesting notions is to look at the notion of risk. Today, we very much regulate the financial sector with a financial notion of risk inside. So we very much look at, the one-year financial raison, the resilience to financial shocks, the value at risk, sort of very strong financial components. And we have big troubles to get more social components, economic components, job creation, inequality issues, education into this notion, and even environment. So I think in that sense, the current discussion about climate change and climate risk is very helpful, because it tells us there's a huge societal issue out there, right, which is the vanishing of some cities, the vanishing of some infrastructures, of some ports and so on. Scientists who believe that if this continues, there will be no life possible in the Middle East, because it will just be much too hot and so on. The question is this not taken into account into our financial decisions which steer our investment? So I believe it would be very interesting to reflect on the notion of risk and to see whether this notion of risk would not at some time need to be widened, if you like. And maybe we can take encouragement from the emerging market economies, because it seems to me that in emerging markets, the financial system is much more seen as part and parcel of the economy. Maybe because the environmental concerns are much more present, the social concerns are much more present, the financing needs of the real economy are much more present. If you think of Indonesia, if you think of China, if you think of Thailand and so on. So maybe they don't have, I would say, the luxury to just have a financial system looking at itself. So maybe it would be very interesting, is I would say, these are the two ideas I can only offer, is to say, well, I think the notion of risk is interesting. Do we have to widen it? And maybe to look at the experience and the treatment of this in emerging countries, which seems to me is a little bit broader, which is a little bit better anchored into the real needs of the society, up to even climate issues.
Thanks. So I'm just going to kind of build upon a few things you've been touching on in the framework of climate risk. And you have a lot of research coming out right now that's talking about carbon bubbles and stranded assets. And do you view this as a systemic risk that will come, that we can be preemptive of within financial markets? Or do you see this as something that within this kind of self-inward-looking reflexivity of the markets that, it's something that will be another bubble that's more likely to burst?
I would say there is an increasing consciousness of the issue. There's also an increasing scientific evidence that becomes overwhelming. I believe that even those who may be critical about the role of CO2 in global warming would all still believe in the benefits of diversifying again towards different energy sources, of diversifying again from sort of burning oil and coal and sort of transport and energy generation. Also because we feel in many cities the side effects. You think of pollution, both in advanced cities, London, Paris, but also of course in China. So I think the consciousness is growing. I see more and more investors looking at this issue very critically, and also the long-term investors trying to make a contribution on responsibility. We have the COP21 coming up. We will see what the outcome is, because in international negotiations, things are only agreed when everything is agreed. So we really have to wait until the last day. I can only say that the insurance community is more and more aware of that issue. And our conviction is that a world with +2 degrees may be insurable, even though we will also there see a strong intensification of risks. But a world that would be +4 degrees warming is very difficult to see from today's perspective how this could be insured. Just because the magnitude and intensity and frequency of climate events would become so much more grave.
On this question of where an insurance company or even a private individual should hold his assets, because interest rates are very low at the moment, and presumably there's only one way they can go is up or stay low, does that not make the situation bad for bonds and equities? Because when interest rates go up, bonds tend to go down, and likewise for equities. So is the outlook not somewhat glum, whichever asset class one holds?
I would not be so negative. Only Woody Allen would be so negative, and I'm reminded when I hear you of his saying that life is hard and at the end you die. This is not how I feel, and this is not how I see the financial system. So I believe that if bonds are low, it's a challenge for investors in that asset class, but that is positive news for equities, and you see equities markets growing. I think the challenge is rather that the equity markets are very small. I mean, if you think of the indices that are very few firms. In the leading indices, you have 30, 40, maybe 100 firms, compared to the real economy, where the job creation is often not in these big blue chips, it's often in SMEs. So the question is more, how can we get the financing into these areas which are the sources of growth and of innovation? And here, maybe Europe is disadvantaged because we were a very bank-based economy. And maybe now I'm saying something about the UK and other countries. So having a banking crisis and a bank-based economy is really a source of big trouble. So the idea is now to diversify and to build up a more market-financed structure. And this is an interesting avenue, but it will take a number of years. And very important will be securitization. So do we manage to do securitization of assets where you could invest in a financial, in a security, but actually have exposure to SME loans? And this is, I would say, one of the biggest issues that the European Union is currently looking into and struggling with, how to make that work. Because the asset classes are much more heterogeneous. You know, every firm is different, whereas you have in real estate much more homogeneity. So the question is how you can securitize this, how you can invest then in assets which after all are linked to the real economy, which are more sources of growth. I think that's one of the big interesting avenues to look at. So I would be a little bit more optimistic than you are.
So to amplify on questions by Anders and Daniel, in your presentation you mentioned the perils of marking to market. But so first a minor comment, you define marking to market as the price you would pay to exit. But actually it's not the price to exit, it's the price to sell one share. And those things can be very different.
Yes.
And because exiting, if you're a big player, you might depress the asset by 10% or something. And this is a big effect, not only because it means there's an inaccuracy in your portfolio, that's the small part of it. The big part of it is that big depression comes about because you're propagating systemic risk. So if the price of the asset drops, that means if you have a leverage target, you have to sell assets, which does two things. It both depresses the price further and it propagates contagion to other assets that you sell as well. So both of those effects send a big effect ricocheting around the market. And when the price of the asset drops, that means other people start to sell their shares. So you have a big amplifying factor that's propagating around that's, I would argue, the dominant source of systemic risk and may in fact be worse. The cure may be worse than the disease. And so I'm just wondering if you agree, because I would strongly emphasize that as being at least as big an effect as the other things you mentioned.
Yeah, I would very much agree with that. I even when I tried to express it, went a step further, said that the exchange value of asset prices, if you push it to the limit, is actually zero, because one cannot collectively exit from diamonds at the same price. That's exactly what I meant, so that's exactly what I refer to. That's why it is so important to preserve diversity in the financial system. And I believe we have it when we go into the system, and we have it outside the system, right? The real economy, the infrastructure, the small, the large, the middle, the innovations, and so on. But then we have, in the middle of this process, the marking to market, the agreement on a daily basis, and evaluate very diverse institutions with the same market price. We all understand, I would say, the intellectual appeal, and it's maybe it's like democracy, so it's, we see imperfections, but we don't know what to replace it with. So I think it would be great to start reflecting on how one can maybe keep some of the advantages of mark-to-market, but so take into account more the diversity of investors, the diversity especially of the investment horizon.
Thank you for a really excellent presentation.
Thank you.
I wanted to ask you about the sustainability challenge and particularly the way that AXA and other insurance companies can speak to governments in a new way. Until fairly recently, I was encouraged by the fact that there was cross-party support for action on climate change, certainly in the UK. But looking at in the US presidential election debate, you've got a lot of Republican candidates who don't believe that climate change is a threat. And in the UK, we've had recent very precipitous cuts to renewable energy subsidy. So the idea that saying that climate change is going to be a huge threat and that, as you rightly said, a 4-degree world is not insurable, it doesn't seem to be making a difference. In fact, we seem over the last 6 months to be going backwards in terms of the regulatory or governmental incentives that governments can do. Now, they are in a difficult situation with austerity, etc., in terms of budgets. But is there a different language that we can use to engage with the centre-right to make your message come across, other than that it's a really, it's a hard-to-insure world?
Well, the way I find is most convincing is to talk to people who are directly affected. And if you talk to people in developing countries, they are completely affected. If you talk to people in Africa, they're completely affected. They're also affected because in the Western world, 50% of these damages are actually insured. In emerging markets, 10%, in Africa, 1%. So it is really a societal issue. If you talk to people in Africa about the poverty circle, they say that the problem is that climate risks brings people back to extreme poverty. So yes, a farmer starts to plant and has crops and starts to sell and putting up a small business, feeds his family, invests, and so on and so forth. but then one day could be wiped out completely because of climate risks. And that is the biggest challenge in sort of say developing countries. And you see in these countries also, again, that the intensity and frequency and severity of these impacts is very much growing. And the evidence, if you talk to many professions on the health side, they see these problems moving forward. If you talk to people on urban planning, the water problem in Sao Paulo, the water problem in California, these are very, very existential issues. AXA did a study, and I don't know if that helps your audience, but I found it very interesting. And we did a study asking 1,000 companies, small, medium-sized companies around the world on climate risk, and 40 cities. So 19 countries, and we just asked, is that a big issue? Are you prepared? And of the corporations, 3/4 said it is a big issue in the medium and long term, and only 1/4 said we are prepared. So firms, even SMEs, feel it because of global production change. So they tell you, yes, I've not been affected directly, but my supplier from Singapore was flooded, and my other supplier in Mexico was hit by a storm, and these kind of things. So I would say, if you talk to economic actors, I was surprised to see the degree of awareness of the issue. And cities are increasingly aware. So I would say on the survey shows all the cities are aware. And it's just a question to which they are preparing now resilience plans, and many are working to that. Because you know that we talk about climate change as a global risk, but it will really hit in the cities. I mean, 50% of the global population live in cities today. It'll be 60% in 2030. It'll be 70% in 2050. So I would say if you talk to any mayor, and even in the US, we have seen these examples, they know very well the growing intensity of climate change. So I think only few people have the luxury to ignore that. I don't know where they live, but I would say if you look at the survey, the numbers show you that many people are aware across the globe.
My name is Gesine Reinhardt. I'm from statistics. I wish I could ask another question on climate change, but my question is much more profane, linking to what Doyen asked about systemic risk. So this, so many banks and insurance companies are interlinked through a network, through an interbank lending network, through other networks ensuring the same risks, for example. One way of getting cascades is through densely connected components in this network. So one bank defaults, but there's lots of interbank lending agreements with other banks that might default. You probably know this better than I do. So the underlying network structure itself could be another factor which one could consider for risk assessment. Is that something that you would find important, or that AXA would look into?
Yes, I think it's very important, and thanks for making that point. And I think what is interesting is that if you think that to the end, you again come to the difference between banks and insurers. So I would say banks and insurers have 2 similarities and 4 differences. The similarities are financial intermediaries and large investors. That's the similarity in banks and insurers. The differences are, 1, banks are interconnected through the interbank market, and insurers are not. So banks manage liquidity risk. You cannot be the only bank, because the liquidity risk you cannot insure yourself. So you manage treasury always as a network. There's an interbank market, which is really the first sign and source of contagion. And insurers are not interconnected. So insurers don't lend to each other, and they are sort of not interconnected in the institutional way, and they do reinsure their risks. So a small fraction is passed to reinsurers, but these are not contracts that can be called upon will. It's just upon catastrophes, for example. So when you have... Yes, but this is exactly, I mean, it's a very interesting system where you have the reinsurance, and they have a very strong standing because they have invested heavily in modeling, and they measure very much their exposure. These are mostly global operators and need to diversify. So the key for insurers is really the diversification. And I would say the difference is very important that they are not institutionally interconnected. So you don't have immediate balance sheet contagion. And the other factors is that insurers don't face the liquidity risk, and they are not susceptible to run. Insurers are not leveraged, because they are not raising debt to finance operations, and they're not handling the money or the payment system. So I would say if you look at the institutions, it is very different, and by the way, it feels very different. Insurers don't have trading floors normally. They're buy and hold investors. They look very much at the long term. And the banks are very much have to look, of course, on the liquidity risk, on the deposit risk, and on the measurement of treasury. So these are two different worlds. I would say the quality of the network is quite different. And if you look at sort of empirical studies that have been done, they all show that the network intensity is much deeper for banks than insurers.
We've got time for one more.
Thank you, Christian. Really enjoyed your lecture. A question on mark-to-market. You can only mark something to market if a market exists.
Yeah.
And increasingly, through all the things you described, we're destroying market diversity. Liquidity in a market only exists if you have diversity. If you have people selling when people want to buy and people buying when others want to sell. And the mark-to-market makes everybody want to sell at the same time and buy at the same time, as another speaker beside me mentioned. So the quality of market becomes a fundamental issue. And are you finding that in their focus on mark-to-market, that accounting bodies, central banks, and regulators in Europe are understanding that as an issue?
My answer would be positive. I think they do. So they have invested very much about market resilience, about market infrastructure, about moving things to market. If you think of derivatives and so on, I think that issue is there. So the markets are functioning in the way that we describe them. I think the real issue that is not yet at stake so much, or not yet seen by everyone, where the disagreement is how you bring in people with a diverse background, and whether you really should apply the same market price to their balance sheet, because their exposures are so different. And that's the challenge. And I believe the challenge is that most people would even agree with the diagnosis. It's the lack of treatment. So mark-to-market, I mean, it's published daily, it's easy, it's convenient. You have the research telling you why the oil price today is what it is exactly. And, you know, as I say, economists are fantastic ex post rationalizers. So then explaining you whatever market price, you have the research underlying that. The difficulty is, what could you replace it with? And I think that's the thing people haven't cracked. So would you take a function of the average? You probably don't take historic accounting, because you want to look forward, you don't want to look backward. So how do you take into account the different investment horizon? How do you take into account the different liability structure? So if I can, let's say I'm a pension fund, and let's say I really have my next liability credibly pay out in 10 years and not before. So why would the regulator apply to me today's market price and the next quarter's market price? The only question is, what price should the regulator apply? And I think it's on that where much more research is needed. And I think it would be great to have a breakthrough there, but not pouring out the baby with the bathwater. We still need the information to the investors. So nobody's against transparency. Nobody's against publishing reports on whatever frequency is useful. The question is only, what is the quantified information that? Because at the moment we put in the market, and then we say, well, that's too much, and then we put the volatility adjuster in it. You see, so we're all aware that it's not the right thing, but nobody has yet found that, and I believe the next agenda for research should really very much focus on this, because this is how you get diversity back into the system.
So before we thank Christian for what's been a brilliant talk, I just want to flag up one particular event that I think quite a few of you in the room might be interested in. We have Lord Adair Turner speaking here next Tuesday, 24th. He's launching his new book, which really delves into the financial crash and the reasons for it. So it's been described by George Soros as an eye-opening account, so I do urge you to come to that. And one final plug, if you haven't already picked up a copy, there's a report on the Oxford Martin School's first 10 years of research, so do grab a copy when you go, because it's great reading. And that just remains to be said. Thank you very much for a brilliant talk, and I think a really great Q&A session as well. Thank you.